All right, let's jump right into this explainer and unpack exactly how Amerant Bancorp is navigating a really massive growth phase, looking specifically at their latest 2026 reports. You already know the regional banking sector demands ruthless discipline and a sharp strategic vision. Well, today, we're putting Amerant under the microscope. We're going to weigh the undeniable green flags and their recent performance against some underlying warning signs that the mainstream media might just be glossing over. What's genuinely wild here is the sheer scale of this move. During the second quarter of 2026, Amerant officially pushed past that heavily regulated $10 billion asset threshold, hitting exactly $10.3 billion. Now, in the banking world, this is a massive tailwind. It ushers in a whole new era of scale, liquidity, and serious market presence. But crossing this line, it also means stepping right into the crosshairs of heightened regulatory scrutiny. Their operational machinery absolutely has to be perfectly tuned from here on out. So here's our roadmap for today's explainer. First, the $10 billion milestone. Second, we'll go inside the financial ratios. Third, institutional backing and ownership. Fourth, the 4 pillars of their strategy. And finally, analyst forecast and outlook. Let's get to it. Section 1. The $10 billion milestone. Unpacking Q2 2026 performance. Take a look at their sequential improvement here. Net income jumped from $17.9 million to a solid $21 million. And that directly translated to a 20.5% sequential increase in earnings per share, jumping from 44 cents up to 53 cents. That is a crystal clear positive indicator. It tells us that as the bank is ballooning its asset base, it's also effectively scaling its actual profitability. And going beyond just top-line growth, we're seeing really improving asset quality trends. A major win here is the steep drop in their provision for credit losses, falling from $7.8 million down to $4.8 million. That tells us management is feeling way more confident about the underlying health of their loans. But hey, we've got to acknowledge a slight warning sign hiding in the margins here. Their net interest margin actually compressed a tiny bit, slipping to 3.52% from 3.55%, mostly due to competitive loan pricing. It's a small dip, sure, but in a high-rate environment, margin compression is something we absolutely must keep a close eye on. All right, Section 2, inside the financial ratios, the mechanics of Amerant's value. So the absolutely crucial takeaway here is the stark contrast between their current price-to-earnings ratio of 21.12 and a forward PE of 11.60. That massive drop, it's a huge signal that analysts are pricing in some serious earnings growth over the next year. Pair that with a healthy price-to-book ratio of 1.24, and we see an explosive return on equity of nearly 55% for the period. If you're hunting for efficiency signals, an ROE that high hits the nail on the head. It shows they are generating substantial profit directly from shareholders' equity. Now, zooming in on capital thresholds, we do see a bit of a headwind in the source material regarding tangible equity. It dipped slightly, taking a hit from about $23.7 million in unrealized losses, net of taxes. But honestly, the bank's core capital levels remain remarkably robust, boasting a total capital ratio of 14.34% and a common equity tier 1 of 11.94%. They are sitting very comfortably above all the standard well-capitalized regulatory minimums. Basically, they've got the safety net required to absorb those unrealized losses. And checking out their lending mechanics, 59% of their loan portfolio is adjustable. Plus, management specifically notes that roughly 63% of these loans are going to reprice within just 1 year. Now, this is a classic double-edged sword. If interest rates stay high, this is a massive advantage. The bank is going to capture those higher yields super fast. But if the Fed pivots and starts aggressively cutting rates, this heavy weighting toward adjustable loans could morph into a major liability, rapidly dragging down their interest income. Moving on to Section 3. Institutional backing and ownership. Who exactly is investing in AMTB? Well, what we find here is super encouraging. Over 42% of Amerant Bancorp's stock is currently locked up by institutional investors. That represents some serious smart money confidence in their recent transition and their overall ability to execute effectively at this new $10 billion scale. Just to put that into perspective, over the last 12 months alone, 86 institutional buyers drove nearly $130 million in inflows. Leading the charge are major funds like Wellington Management, Patriot Financial, and North Reef Capital, quite literally pouring millions into the stock. Whenever you see this kind of targeted multi-million-dollar institutional accumulation, it's a massive vote of confidence that Wall Street's heavy hitters are seeing some deep underlying value. All right, Section 4.
Four pillars of strategy. Management's blueprint for 2026.
To justify that kind of money, Amerant is executing a very strict four-pillar plan. Number 1, transform their credit profile. 2, drive operational efficiency. 3, a relationship-first approach. And 4, execute disciplined balance sheet growth. In action, this actually means dealing with some past liabilities head-on. They're actively slashing bad, criticized loans straight off their books. They're also capping expenses near $68 million to hit a really tight, highly efficient 60% efficiency ratio. And here is a fascinating advantage, basically a unique economic moat for Amerant. They are leaning into long-standing Venezuelan client relationships. Because of their unique geographic positioning in South Florida, they are capturing low-cost, incredibly sticky international deposits that other regional banks just literally cannot access. Real quick, before we look at their ultimate goal, let's just baseline return on assets, or ROA. It's simply the measure of how effectively a bank uses its total assets to generate pure profit. In the banking sector, locking in an ROA of 1% is widely considered the absolute gold standard for a highly profitable, well-oiled machine. And that brings us right to management's ultimate strategic finish line, achieving that full 1% return on assets by the fourth quarter of 2026. They're building off the 0.84% they just reached in Q2. Look, if they can successfully pull the levers on those four pillars, cutting the bad loans and leveraging those sticky Venezuelan deposits, hitting this 1% target is going to fundamentally re-rate how the entire market views this bank. Finally, Section 5, Analyst Forecasts and Outlook. Projecting the future of AMTB. Now, despite the major milestones and all that heavy institutional buying, we do have a distinct note of caution from the analyst community. The current consensus from analysts polled by S&P Global remains a very cautious hold. This basically suggests they expect AMTB to perform right in line with the overall market for now. They're probably waiting to see if management can actually deliver that 1% ROA in reality before they upgrade the stock. However, it's super interesting that their average price target sits at $31.88. So even while slapping a hold rating on it, analysts are seeing nearly a 9% upside from current price levels, with the highest targets reaching all the way up to $33.50. The math is clearly pointing upward, even if those official ratings are lagging a bit behind. So this leaves us with a really fascinating question to ponder. As Amerant actively executes its four pillars, cleans up its credit, and drives profitability higher toward that magical 1% ROA, will Wall Street be forced to upgrade their outlook before the year even ends? The underlying fundamentals are shifting rapidly here, and it is definitely a space you're going to want to watch. Thanks for joining me on this explainer, and definitely keep your eyes on how these mechanics play out in the quarters to come.